All right, so a quick review of what we've talked about. We've been looking at relevant versus irrelevant costs, and we were able to, in the previous video, as you can see, we've done several things here. So let's just go back and have a quick review. We said that relevant costs must have a future orientation and differ among at least two alternatives. We said that once we make a decision to do something, anything that it's going to cost us is a relevant outlay cost. We talked about sunk costs. These are often fixed costs, but any time we make a decision and we act on it and incur that cost, that decision is now in the rearview mirror and we have what we call a sunk cost, and those are irrelevant. And then question 4, we noted that all of these statements, A, B, and C, were true of sunk costs. And then we also said, question 5 was interesting. We said that the answer was B because it deals with the book value of this ship. If we had changed this to market value here, then we would have the answer choice be A, but book value is not relevant to decision making because relevant costs are the result of a past decision, making both the historical cost and the current book value irrelevant. Okay, and then number 6, we said that disposal and salvage values are relevant costs because they occur in the future, deal with decisions that have not yet occurred. So disposal value is very much the same thing as market value. We find out how much we could get for something if we disposed of it, so that makes it a relevant cost. And then salvage value is an estimate of future value, so obviously if we're making an estimate, it has not happened yet. So picking up then on question number 7, it says blank are the net cash inflows that could be obtained if the resources committed to one action, remember we talked about scenario A, B, C, and so forth, were used in the most desirable other alternative. Okay, and this is what we call an opportunity cost. And what we want to make sure we recognize about opportunity costs: net cash inflows. Opportunity costs are not anything that we actually spend money on. So if I give you, for example, scenario 1 and scenario 2, and I say that we have revenues, let's see here, revenues are 2 million and revenues are 2.2 million for scenario 2, we're certainly going to focus on those two potential revenue streams, but then we also have to subtract out, let's not go with expenses, let's go our actual costs, what it's going to take, okay? And this question mark represents the net cash inflows of these two scenarios. So again, obviously scenario 2 has a little bit more revenue associated with it, but if the costs are too high, could be that alternative 1 is what we go with. Well, assuming that scenario 2 was still profitable, or scenario 1, whichever one we don't choose, we still lose the benefit of whatever we do not choose. So a lot of you watching this are in college, and you are paying opportunity costs simply by being in college because you're not out working, or you're not out working as much as you could be if you were not in school. Okay, so this is not a type of cost. We don't. This is not like an expired versus unexpired cost or anything like that. This is just the benefit that is foregone by not doing something. Okay, so you go to college and work 10 hours a week versus not going to college and working 40 hours a week. Well, your opportunity cost are those 30 hours plus whatever you would, times whatever you would make on those 30 hours. Okay. question 8, it says sunk costs are always relevant or irrelevant, and opportunity costs are always relevant or irrelevant. Well, we actually covered the first part of this in the previous video, and so sunk costs are the result of past decisions making them irrelevant. Opportunity costs are always relevant because we could have done it, right? And we had to choose between alternatives. Question number 9 doesn't exactly fit into the topic too terribly much, but sometimes whenever we are trying to choose, we know that, hopefully we know that the 3 components of product cost are direct materials, direct labor, and factory overhead. Okay, and so we say sometimes what a question will do is it will give you something like, it'll tell you how much the direct materials are per unit, and then it will say conversion costs are so much per unit. So what we want to understand is we've got prime and conversion cost. Direct materials and direct labor. And we call these prime just simply because there's a set amount that we put into there, into the finished good, whatever it is that we're making. Conversion costs are actually direct labor and variable factory overhead. And so so notice that direct labor is sum of both, right? Or it's actually both a prime and conversion cost. And so managers will sometimes break product costs down into prime and conversion costs so that they can see where there's areas for improvement. All right, so let's not get too caught up in all of that. But given the definition that we have for conversion costs, we can look up here and we can say, okay, the answer must be answer choice C. That's the one that fits with our little formula that we had down here. So in the class I teach, we actually have a PowerPoint slide that mentions conversion costs, and it provides a definition for that. So this is just a way to reinforce that. Some of you may not know what prime and conversion costs are and what you just learned. Others of you may have already known that. Okay. All right. So let's take a look at one more question and see what we come up with for it. This is a question, a little bit longer scenario. All right. And it says, Smith & Sons is considering a new drilling machine and for its manufacturing plant, and they have an old drilling machine that originally cost $10,000 and has $7,000 in accumulated depreciation. They're considering a new machine which can be purchased for a cash cost of $16,000. However, the distributor of the new machine is willing to give them a trade-in value on their old machine, the one they're using right now, thereby reducing the cost of the new machine to $14,000. And so the question says, based on this information, calculate the total relevant cost of acquiring the new machine. So we have to make sure that we don't include anything that is irrelevant. So this $10,000 right here, I'm going to abbreviate. I'm going to put SC. That's not South Carolina. It's not Southern California. That's sunk cost. And any depreciation that we've taken that is accumulated over time, 10,000 minus 7,000 tells me that we've got a book value of 3,000. But this 7,000 here, this is just the, accumulated depreciation is just a contra account for the actual asset. So these are both considered to be sunk costs here and are not relevant to the decision. Okay, we do not have to purchase the machine. So our alternatives are purchase the machine for $16,000, or don't purchase the machine, in which case you incur $0. So this is an important figure here. This is a relevant cost. And then we also have to consider what we can get as a trade-in value, which is not explicitly listed, but we can kind of figure it out, right? It's $2,000 for the trade-in. Well, here's the thing. If we decide to keep the old machine, we do not get the $2,000. If we buy the new machine, we get the $2,000 for the old one. So this $2,000 is a relevant cost because it has the ability to make the net cost of the new machine $14,000. So our answer here, as we go through the answer choices, is simply answer choice C. Okay. Take a look at the rest of the answer choices and make sure that you understand why they're incorrect. A, does not account for the trade-in value. B, accounts for the trade-in value, but then it wants to add back the book value, and we already said that was a sunk cost, so that's not relevant. And then D, what they're doing there is they're saying $16,000, and then they're netting the book value against the cash proceeds on the trade-in, and they're saying that there's a $1,000 loss there. But a loss will impact net income, but we do not consider the $3,000 book value whatsoever. Only the $16,000 and the $2,000, because those are components that we have control over. We already did this, and we already took the depreciation, therefore not relevant to our decision. All right, that's it for this video.